It is, it's a very specific kind of thrill when you finally get that job offer letter in your inbox.
Oh, absolutely. Best feeling in the world.
Right. You scroll past a welcome message, your eyes jump straight to the base salary, and then right there in the next paragraph you see them. Stock options.
The magic words.
Yeah, it sounds incredibly glamorous. I mean, it feels like you have suddenly arrived in the big leagues.
You're a shareholder now.
Exactly. But then you read the fine print, and you are just staring at this wall of dense financial jargon.
Yeah, the excitement fades pretty fast.
Totally. It's all NSOs, vesting cliffs, strike prices, tax implications, and that thrill instantly turns into like a low-grade panic.
Which is completely fair because it's essentially a legal labyrinth.
Okay, let's unpack this,
Yep.
because mastering this one specific financial mechanism is, it's really the ultimate shortcut to making a truly informed career choice.
It really is.
So, our mission today is to take a detailed financial primer on non-qualified stock options, NSOs, and translate all that jargon into the exact mechanics you need to know before you sign on the dotted line.
And we are looking at a compensation tool that is, well, it's ubiquitous in the corporate world right now, especially in tech.
Yeah, they're everywhere.
But they are astonishingly misunderstood by the very people receiving them.
Which is wild, considering how much money is on the line.
Exactly. The source material we are dissecting today lays out a very clear reality. NSOs are an instrument of extreme leverage.
High risk, high reward.
Right. To navigate an offer that includes them, you really have to look past that glamorous idea of being a partial owner.
Right, you have to look at the math.
You do. You have to understand the strict mechanical balance between the potential for life-changing reward and some very heavy, often completely hidden financial risks.
Well, to understand that risk and the reward, we first have to, define the beast. What actually are these things?
That's the best place to start.
So the source defines a non-qualified stock option as basically an agreement. It gives an employee the right to purchase a set number of company shares at a preset price within a specific window of time.
And that preset price is key.
Yeah, the document refers to this preset price as the grant price or the strike price or the exercise price. They all mean the same thing, right?
Yeah, they are completely interchangeable terms.
Okay, so the clearest way I can visualize this mechanism is to think of it as like a VIP rain check or a highly restrictive coupon.
A coupon is a great way to think about it.
Right, like imagine a store gives you a binding coupon that says, no matter how expensive a specific high-end television gets over the next 10 years, you have the contractual right to walk in and buy it for today's price of $100.
I love that analogy. And the power of that coupon relies entirely on locking in today's price for a transaction you might not even initiate for half a decade.
Because you're betting the price goes up.
Exactly. The fundamental expectation baked into this whole corporate model is that the company's valuation, and therefore its share price, is going to steadily increase over time.
So the coupon becomes more valuable.
Right. If your grant price, your locked-in coupon price, remains lower than whatever the future open market price happens to be, you get to acquire that asset at a massive guaranteed discount.
But I want to push back immediately on the naming convention the financial industry uses here.
Oh, the name NSO.
Yeah. Why call it non-qualified? It sounds like a bad thing, like getting a non-qualified doctor.
It really does sound like a red flag, doesn't it?
It totally does. In the financial world, usually when an account is labeled non-qualified, it means you're about to get hit with a penalty or, you're locked out of some crucial tax shield. Is this a warning sign?
It sounds like a pejorative, but it simply refers to the IRS tax code.
Oh, so it's just tax jargon.
Basically. Our source primer contrasts NSOs against another category called incentive stock options, or ISOs.
Okay, and those are the qualified ones.
Right. ISOs meet a very strict, highly complex set of statutory requirements under the Internal Revenue Code. And because they meet those, they get granted favorable tax treatment.
So NSOs just don't meet those rules.
Exactly. NSOs simply do not meet those specific statutory requirements. They do not qualify for the special tax shield.
Hence, non-qualified.
You got it. But, and this is the important part, because they don't have to jump through those massive regulatory hoops, NSOs are infinitely more flexible for the employer to hand out.
Ah, So the company prefers them.
Very much so. That flexibility makes them the most common form of equity compensation by a wide margin.
Flexible for the company to hand out, sure, but they come with very rigid strings attached for the employee holding that coupon.
Oh, absolutely. The flexibility is entirely one-sided.
Yeah, the primer details a whole gauntlet of strict parameters you have to survive just to use them.
Now, let's talk about the expiration dates first.
Right. If you don't actually exercise your options, meaning if you don't use your coupon to buy the stock before the expiration date passes, they vanish. Poof, gone.
Which is a hard deadline. But more importantly, there's the vesting schedule.
The golden handcuffs.
Exactly. The terms require you to wait a specific period of time before you actually earn the legal right to exercise them. You don't just get them on day one.
The standard structure you will see in these agreements, according to the source, is a 4-year vesting period with a 1-year cliff.
That cliff is brutal.
It really is. That means if you start your job on January 1st, you earn absolutely 0 options for the first 364 days.
Nothing. 0.
If you quit, or God forbid, if you are fired on day 364, you walk away with nothing.
It is only on your 1-year anniversary, the cliff, that the first 25% of your options suddenly vest and become yours to exercise.
And then after that cliff, the remaining options typically vest in equal monthly installments over the next 3 years.
What's fascinating here is how companies use these strict parameters to actively manufacture employee loyalty.
They're controlling the labor force.
Totally. This isn't just about handing out a bonus. It is a highly engineered retention tool.
They are structurally incentivizing you to stay.
Right. They want you to push through burnout or, toxic management cycle because your potential payout is locked behind that vesting schedule.
And even if you make it past the cliff, the source points out another trapdoor. Clawback provisions.
Oh, those are terrifying.
Yeah. The company can embed clauses that give them the right to reclaim your vested NSOs under certain conditions, like insolvency, or, crucially, if the company goes through a merger or an acquisition.
So even if you earned them, they can take them back.
Yeah, they can just pull the vested options right back out of your hands if a private equity firm swoops in to buy the company.
And furthermore, if you do decide to quit on your own terms, most NSO agreements state that you only have 90 days after your termination date to exercise your vested options.
Wait, only 90 days?
Usually, yes. If you don't have the liquid cash to buy the shares and pay the taxes within that 90-day window, you forfeit everything you spent years earning.
Which bridges us directly into the real motive behind all this. I mean, if the strings are so tight, if leaving the company means losing the options, and if they can just claw them back, why would anyone agree to this?
That is the million-dollar question.
Right. Why not just look the hiring manager in the eye and demand a higher competitive cash salary?
Well, we have to look at the employer's balance sheet to understand why they push these so heavily.
Which brings us to the startup gamble.
Exactly. The source explains that NSOs are heavily utilized by early-stage companies, tech startups, and smaller businesses that are, quite frankly, rich in equity but starved for cash.
They just don't have the money.
Right. These organizations simply do not have the runway to pay top-of-market all-cash salaries to the specialized talent they desperately need to grow.
So they issue NSOs to bridge the gap.
Yes, they use equity as a substitute for cash compensation.
It allows the business to preserve its limited operational capital while still, making a nominally competitive offer to a top-tier engineer or executive. So basically, the company is paying you in lottery tickets instead of cash, asking you to assume their business risk.
That's a very blunt way to put it, but yes, it's a deliberate transfer of risk.
They are saying, look, we cannot pay you what your labor is actually worth today, but if you take a pay cut and help us build this rocket ship, this lottery ticket will eventually be worth millions.
And you are personally subsidizing the company's payroll with your lost wages.
Exactly.
The primer frames this as a shared risk and reward scenario. By accepting NSOs in lieu of market rate cash, employees do take on the very real risk of a new business failing.
Which happens a lot.
All the time. But they also gain access to a return profile that a standard W-2 salary can never offer.
Right, if they hit the jackpot.
Exactly. If the company executes its vision and the valuation skyrockets, the financial gain far exceeds whatever a standard 5% annual raise would have yielded. The leverage is immense.
However, the downside risk is absolute.
Yes. If the company's valuation stays flat, or if it runs into insurmountable macroeconomic headwinds, those options expire entirely worthless.
Meaning the employee took a tangible, multi-year pay cut, for a payoff that never materialized.
Exactly. You essentially have to act like a venture capitalist assessing your own employer.
Yeah, you can't just be flattered that they offered you 10,000 shares. You have to figure out what those shares actually represent.
Right. The math matters.
Because 10,000 shares sounds incredible until you find out the company has issued 1 billion shares total, meaning your slice of the pie is microscopic.
If we connect this to the bigger picture of your career trajectory, the primer draws a very sharp bottom line for the employee.
Which is?
You must rigorously interrogate the company's capital structure and its realistic growth prospects.
Do your homework.
Yes. You need to ask what percentage of the fully diluted equity your options represent. You need to understand their path to profitability.
And if they don't have good answers?
If the business model seems fragile to you, or if the equity grant is mathematically insignificant, the source's directive is clear. You should aggressively negotiate for a higher base salary instead of accepting the speculative risk of the options.
Okay, but let's assume you do that rigorous interrogation. You believe in the founders, you take the startup gamble, you accept the NSOs, and you work your tail off.
Everything goes according to plan.
Right. The company explodes in growth, the valuation skyrockets, and your vesting cliff is in the rearview mirror. You are looking at your vested options and you are ready to cash in.
This is where the headache really begins.
Yeah, because the primer transitions from the corporate strategy into what is easily the most intimidating part of the entire document, the tax trap.
It catches so many people off guard.
Because turning that paper wealth into actual money to buy a house or whatever is not a simple transaction.
Not at all. The moment you decide to turn those options into shares, you trigger a harsh two-step tax process.
And the distinction of being a non-qualified option dictates everything that happens next.
Right. The source advises that the logical time to exercise an NSO is when the market value of the share is demonstrably higher than your preset grant price.
Meaning your coupon is deep in the money.
Exactly.
So you pull the trigger. You exercise the option to buy the stock at your discount. Here's where it gets really interesting and frankly completely counterintuitive.
It defies basic logic for most people.
Yeah. According to the primer, the very act of exercising your option triggers tax event number 1.
Just buying the stock triggers a tax.
Yes. When you exercise an NSO, you must pay taxes on the spread, meaning the difference between the current market price and your original grant price.
The source calls this spread the compensation element.
And the IRS treats this spread as ordinary income, slapping it directly onto your W-2 for the year.
Let's put concrete math to this mechanism to see why it shocks so many people.
Yeah, let's hear the numbers.
Imagine your grant price is $10 a share. The company has done phenomenally well, and the current market price is $50 a share.
Okay, a huge win.
Right. You decide to exercise 10,000 of your vested options. So you write a check for $100,000 to the company to buy those shares at your $10 strike price.
Simple enough so far.
But you now hold shares with $500,000 on the open market.
Wow. Yeah.
That $40 per share difference, a total of $400,000 in value you just gained, is viewed by the IRS as the compensation element.
But wait. I haven't sold a single share. I just bought the stock using my coupon. I wrote a check to the company, but I don't have $400,000 of actual liquid cash in my bank account.
The IRS does not care about your liquidity.
That is brutal.
From the perspective of the tax code, that $400,000 discount is your compensation. It is identical to the company handing you a $400,000 cash bonus, taxing it, and then you taking that post-tax cash to buy the shares on the open market.
So they view it as income, even though it's tied up in the stock.
Exactly. The value was transferred to you in exchange for your labor. Therefore, that $400,000 gets added to your W-2 as ordinary income for that tax year.
That's insane.
You owe standard income tax, payroll tax, Medicare, everything on money you have not yet realized in cash.
So you could easily owe a 6-figure tax bill to the IRS in April just for the privilege of acquiring the asset.
Happens all the time.
How does an employee who is living on like a startup salary actually pay a massive tax bill on phantom income without going into debt?
Well, the most common mechanical solution to this liquidity crisis is what brokerages call a cashless exercise, or a sell-to-cover transaction.
Sell to cover, how does that work?
When you exercise your options, the brokerage platform simultaneously sells just enough of your newly acquired shares on the open market at that $50 price to generate the cash required to cover both the cost of buying the shares and the estimated tax withholding.
Oh, okay, so it handles it for you.
Right, you never have to bring outside cash to the table. But the downside is you end up holding significantly fewer shares than your original 10,000 option grant because you had to liquidate a large portion immediately just to satisfy the IRS.
But wait, if you are forced to sell shares immediately to cover the W-2 tax hit, that brings us right into tax event number 2.
The double tax.
Yeah, because the IRS taxes you when you buy, and they
Mhm.
tax you again when you sell.
Tax event number 2 is triggered the moment a share is sold. You must report the capital gain or loss on Schedule D of your tax return.
And the crucial mechanic here is your cost basis.
Exactly. Once you exercise and swallow that W-2 ordinary income hit, your new baseline cost basis for those shares resets to the market price on the day you exercised.
So in our example, your new cost basis is $50.
Yes.
Okay, assuming you know the basics of capital gains, that holding an asset for over a year unlocks the much lower long-term capital gains tax rate. The strategy here becomes a massive balancing act.
It really does.
If you do a sell to cover and liquidate shares on day one just to pay the withholding tax, your gain is zero, right? Because your cost basis is $50 and you sold at $50.
Exactly. No extra tax on those specific shares.
But for the remaining shares you decided to hold on to, the clock starts ticking.
This raises an important question about how much market risk you are willing to stomach for the sake of tax optimization.
Okay, that's a huge risk.
Right. If you sell the rest of your shares 6 months later for $60, that $10 profit is a short-term capital gain, meaning it's taxed at your higher ordinary income rate.
Just like regular salary.
Yeah. But if you can hold those shares for 12 months and 1 day after exercising, any profit above $50 qualifies for the favorable long-term capital gains rate.
But the danger of holding an undiversified asset for a full 12 months just to chase a better tax rate is terrifying.
It is a massive gamble.
You just paid ordinary income tax on a $50 valuation. What if the market turns, the company misses earnings, and the stock plummets back down to $20 during that 1-year holding period?
That is the nightmare scenario the primer implicitly warns against.
It's the stuff of nightmares, truly.
Because if the stock drops to $20 and you finally sell, you have a massive capital loss of $30 per share.
Ouch.
But the tax code only allows you to deduct a maximum of $3,000 of capital losses against your ordinary income per year.
Wait, what?
Yes, you cannot retroactively undo the $400,000 of W-2 income you already reported and paid taxes on.
Oh my God.
You are left with a massive permanent tax bill paid on wealth that vanished before you could liquidate it.
That is, it's a high wire act without a net.
It absolutely is.
You are balancing your vesting schedule against an expiration date. You're predicting the broader stock market, trying to scrape together cash for W-2 withholdings, and betting that the company valuation won't collapse while you wait out the capital gains clock.
It requires an incredible amount of financial planning.
So what does this all mean? If we synthesize the mechanics, the strategy, and the tax traps from this primer, the takeaway is that NSOs require active defensive management.
They are not set it and forget it.
No. They offer incredible upside if a company booms, but you cannot treat them like a passive 401k match.
Not at all.
You have to understand the math of the tax spread,
Mm-hmm.
you have to plan your liquidity before you exercise a single share, and you have to aggressively evaluate the company's fundamentals before you trade your hard-earned labor for a restricted coupon.
The necessity of defensive management cannot be overstated. And as we conclude our analysis of this primer today, I want to leave you with a final thought to mull over.
Yeah, let's hear it.
It expands on the source's brief warnings about business risk and insolvency. It is the concept of the concentration of risk. Look critically at your current financial foundation. If your daily salary, the cash flow that pays your mortgage and feeds your family, and your primary wealth-building mechanism, your stock options are both entirely anchored to the exact same company balance sheet, you have placed an immense concentrated bet on a single point of failure.
All your eggs in one very fragile basket.
Exactly. What happens to your personal financial safety net if that specific company or even that broader industry sector experiences a sudden macroeconomic shock?
Yeah, what happens?
Well, your daily income could evaporate in a round of layoffs at the exact same moment your unvested options are clawed back and your vested options plummet to zero.
A total wipeout.
Right. It is a stark reminder to think deeply about how powerful high-leverage tools like NSOs fit into a much broader, intentionally diversified life plan.
That is the ultimate reality check. You absolutely do not want your paycheck and your entire net worth riding in the exact same startup basket.
Diversify your risk, always.
Always. Well, thank you for joining us on this deep dive into the mechanics of non-qualified stock options. We hope we've replaced the dense jargon with actionable strategy for you. Keep interrogating the fine print of your financial lives, negotiate your worth, and we will see you next time.